Hello and welcome to another deep dive episode of the podcast from AJ Bell Money and Markets. In this episode, we are going to be talking about how to invest if you're a cautious investor and afraid of stock market crashes. Now, worrying about falls in the stock market is an affliction which affects most of us some of the time, and some of us, I would say, all of the time. It's probably a particularly salient moment to be talking about this issue because, rightly or wrongly, there are lots of warnings about a correction in financial markets pretty much everywhere you look at the moment. I'm Laith Khalaf from AJ Bell. Joining me on this deep dive is my colleague, Tom Sieber.
Yeah, hi Laith. Yeah, I think you're right. There's probably quite a lot of people out there who are getting pretty twitchy right now about a booming stock market. And equally, there's going to be lots of people who simply worrying about investing in stocks and shares full stop and perhaps have never done it before. So in this podcast, we're going to perhaps try and help with that a little bit by talking about how and why to invest while also mitigating the risk involved. To help us along, we'll be talking to Stefani Williams, a financial advisor from Holden and Partners, about how she approaches the question of investment risk with her clients. And we're also going to be talking to Alastair Laing from Capital Gearing Trust. Now, this is an investment trust which focuses on wealth preservation, but also seeks to deliver long-term growth.
Absolutely. And towards the end of the podcast, we are going to be talking about the drawbacks of conservative investing and also being too cautious with your money. But first, Tom, I think it's probably helpful just to talk about market crashes and just to help put them in perspective because, they are part and parcel of, investing.
Yeah,
they do happen from time to time and they're pretty unpredictable because there's no kind of one cause that's common to all crashes. There's no kind of red warning sign that necessarily goes on. If you look at kind of the recent crashes that we had the COVID crash, of course, actually remarkably short in terms of its duration, given what was happening in the world, right?
Yeah, absolutely.
And, it lasted just a few months. You go back and then I guess the really big crash that we had was the financial crisis. That really went on for 2 years from tip to tail as it slowly unfolded. And then you go back to the beginning of the 2000s, we had the dot-com crash. That was compounded at the time by the Enron accounting scandal and also the World Trade Center attacks as well. And that actually resulted in a 3-year bear market. It was a terrible time for investors. And that dot-com boom and bust really is the one that probably resonates most, I think, with the current market environment, because we're, again, in a situation where there's a new technology. This time it's artificial intelligence. In the dot-com era, it was the internet, of course. And that has now, again, created a bull market in the US and very high valuations in the US stock market, especially within the technology sector. Now, I think it's probably important to note that doesn't mean there's going to be an imminent market crash. The market could continue to rise sharply from here, and we're going to perhaps delve into that a little bit later in terms of the risk of underinvesting during such a boom. But I think for the moment, Tom, we're kind of just setting the scene. So let's talk about perhaps the downside from the kind of boom and bust scenario, focus on the bust, and just talk about maybe how much you can expect to lose during a market crash. If we look back through those last 3 crashes from peak to trough and use the MSCI World Index as our measure of the global stock market, during COVID, it fell 25%. Again, fairly remarkably shallow given kind of the entire world economy pretty much shut down.
Yeah.
But that was the kind of loss that you could have sustained during the COVID crisis. Financial crisis was a bit deeper. 40% from peak to trough, pretty nasty. So £10,000 becoming £6,000.
Yeah.
And a dot-com boom and bust, that was a 50% fall peak to trough, so even nastier. And I think it's worth pointing out that can be accentuated if you're not invested just in a broad global stock market. If you're invested in a particular sector, stock, or even regional market, it can be even worse. So if you look at the tech-heavy NASDAQ index in the US, in the dot-com era, that fell by 80% from peak to trough. So that highlights, about how you can be effective. You've got a particularly concentrated portfolio. Importantly, these numbers are peak to trough, so it's the very worst outcome you could possibly have, right? So if you've experienced that in practice very rarely, it would require you to invest at the very top of the market and not at the very bottom, which
when we talk about timing the market, that's not normally what we mean, is it? But it's the polar opposite of that. But you're right, it would have taken something pretty spectacular to achieve that.
You'd have to be spectacularly unlucky to have exactly those returns. Actually, you probably, even during a market crash, you probably do a bit better than that. And it's important to know that even after market crashes, the markets do recover. So just looking back at those numbers, if you'd invested £10,000 in the global stock market on the eve of the dot-com crash, when the global stock market was about to fall 50%, so really a pretty catastrophically bad time to invest, put £10,000 into the market, beginning of 2000, you would have seen it fall to £5,000 at the nadir of the market, but if you'd kept it invested, it would now be worth over £60,000. And I've got a pretty good stat, I think, Tom, which is actually if you'd invested £10,000 in that NASDAQ 100, which fell 80%, right? So it would have been worth £2,000 at one point. That would now be worth over £80,000. So, that to me is a pretty astounding statistic and does highlight the ability of the markets to bounce back after a big fall. And, that's why, Tom, despite those periodic market crashes, the markets are seen as a good home for your money in the long term, because by taking that risk, you should get more returns in the long run, right?
Yeah, absolutely. So you're quite right to sort of link risk and reward. They go hand in hand when it comes to investing. Theory, that's quite a sort of straightforward and intuitive concept. So to ensure that investors are being kind of compensated for the risk of losing money, an investment needs to pay a sort of requisite higher level of return. So that's kind of the theory behind it. So when you've got assets where there's not much risk of losing your money, so let's say cash or government bonds, the return's typically lower. And then when there's a higher risk of losing money, as we were just talking about, the market crashes there. So when we're looking at the stock market, the potential returns are higher too. Now, it's not necessarily going to work out perfectly all of the time, but that's the kind of theoretical basis of kind of risk versus reward. And it's one that's typically proven accurate over the long term, at least.
Yeah, absolutely. So there's that trade-off between risk and return. And I guess that raises the question of how much risk you should take. If you're younger, you might want to take on more risk. If you're older, maybe less risk. In retirement, you might want to dial down risk. I think there are broadly two questions to address when looking how much risk you can take. The first one is, how long are you investing for? Because the longer the time period you have, the more risk you can tolerate in theory. And the second question is more personal. It's like, how risk averse are you? Even if, you can tolerate more risk because you're young, you've got a long investment horizon, you might not in practice because it's going to cause you sleepless nights, or maybe you're just going to sell out of the market every time it starts falling because you get scared.
Exactly.
Which isn't a great strategy. So also a bit of self-awareness is probably required. So I think this is probably a good time to bring out on our first guest, Stefani Williams. She's a financial advisor with Holden and Partners, and I caught up with her to talk about how she goes about assessing risk when it comes to her own clients. Stefani, thank you very much for being with us today. Let's get straight into it, shall we? When someone actually approaches you, very first of all, your first contact with a customer, they want investment advice. How do you go about getting an idea of what their risk tolerance is, how much risk they should be taking? What kind of questions do you have to ask them?
Okay, so when we first meet a client, first and foremost, we are wanting to get to know the individual, trying to understand them, their family, their current situation, and where they are in their life cycle. So are they building their wealth, or are they sort of decumulating their wealth for retirement? So first of all, we're looking at the objectives and what it is that they are looking to achieve with their monies. And then once we've kind of got a grasp of who they are and what they're looking to do, we will do a risk profile questionnaire. So that provides us with the structure to which we can ask specific questions to try and drill into the level of risk that they are willing to take on a theoretical basis. So,
Sure.
and it will provide us with a score, and then that score will determine where on the risk spectrum they might sit. So when we have the risk spectrum, it's typically a bell curve. So more often than not, you will find people are in the middle of that risk level, and then some might be weighted more highly, and then others slightly more low, slightly more cautiously. But after we've done the risk questionnaire, what we're trying to establish more so is that human risk. What is there? So the risk questionnaire gives us a number, it gives us a percentage.
Yeah.
But whilst that's great to lean on, it doesn't actually provide us with the level of detail that we need to really understand. So it could be that we have an investor who seemingly comes out as adventurous on a risk questionnaire, but really what they are looking to achieve is wealth preservation. So if they're looking to achieve wealth preservation, we're not going to be taking their adventurous risk profile answer. What we're going to be doing is tailoring it to those objectives that they're looking to achieve. So it will be that dialogue to really establish what kind of risk that they should be taking.
And in terms of the questionnaire that you're talking about to kind of risk profile your customers, can you give us a flavour of what kind of questions are on there, or is it a bit of a trade secret?
Of course. So we actually use a third-party risk profiling tool, and we have 10 selected questions on that risk profiling questionnaire.
Okay.
And to give you an idea of the types of questions, it might be, how easily do you adapt when things go wrong financially? Also, there might be something like, when you think of the word risk in a financial context, which of the following words come to mind? Danger, uncertainty, opportunity, thrill. And actually, I think that's quite a nice one for clients to think about, because all too often people consider risk to be associated with uncertainty or danger. But from a financial perspective, actually risk often means the opportunity to gain and the opportunity to have a reward. So that can be quite a telling one for clients to answer. But those are the types of questions that we might ask. And also another one that's quite liked is whether how much you want to gain over and above inflation, for example.
Right.
Because often, when you're taking a risk with your investments, you want it to at least keep up with inflation over a long period of time. And you want to retain that purchasing power. But how much over are you willing to take that risk, and how much over in terms of returns are you wanting to gain?
Are you targeting? Yeah. Okay. And at the moment, the FCA and Treasury say that they're concerned about the amount of cash that people are holding rather than investing. I mean, does that resonate with you? Not in terms of the people that you're already advising, because presumably you tell them how much cash to have and not have, but people who are newly coming to you. Do you find that often people have been saving for entire lifetimes and they've just got it all in cash? Are we really a nation of cash hoarders, or is it a bit more nuanced than that?
I think we probably are, actually.
Yeah.
Quite often I will have people come to me and they just have lots of cash and they haven't invested it because they don't know what they're doing.
Yeah.
And they don't know where to put it. All too often, people are a bit nervous about investing in pensions or in ISAs, which are fundamentally such important tax wrappers that you can really, really benefit from.
But millions of people are happy to invest in Bitcoin, Stephanie, bizarrely.
Well, quite, exactly.
And I'm going to put you on the spot, Stephanie. I'm going to ask you about what I think is a particularly tricky area, which is getting your risk level right if you're in retirement and drawing an income from your pension. Now, I know that there are so many variables here, but are you able to just give us a few pointers about, how you approach that conversation with your clients? What do you tell them the most important things that people need to consider?
Cool. So again, with when you're drawing down from your pension, in retirement, you want to make sure that the amount of that it doesn't run out effectively. You want to make sure that it is lasting your lifetime. So we tend to do a cash flow planning, which is sort of higher level. But for investors who are looking to do it themselves, you want to be taking a level of risk. You don't want to be sitting on a cautious portfolio, because what you are going to be doing is effectively just drawing down that capital, and you don't know how long it's going to last you. Whereas if you take a level of risk, you have the ability to take off and strip away some of the return, as well as maybe some capital as well. But what you're wanting to do is strip out some of the dividends, some of the capital return. So you're prolonging the length of time that you have, the underlying value associated with your pension, so that it doesn't run out. But I would always say to my clients, if you're looking to invest in drawdown, you are doing so. In order to do so, you need to take a level of risk. If you don't want to take a level of risk, then your best bet is putting it into an annuity and having an annuity income.
Yeah, absolutely.
But I would say at least a medium level of risk for drawdown is about right.
Yeah. Okay. And just finally, Stephanie, if I could just ask you, are there any other common mistakes that you see when investors are thinking about how much risk they should take, or perhaps even having chosen how much risk they take when they're implementing a plan which fits that risk tolerance? Any common pitfalls?
Yeah, so I guess it's investors may take flight during bad times. So when things are going wrong, all too often, investors might get scared, a bit nervous, and understandably so, because they might see that their pot is falling, particularly if it's a pension in a pension environment and it's their livelihood that's at risk. So all too often people might think, actually, let's secure it now. But all too often, if it's at that point, you've already lost money. So you're crystallizing that loss rather than seeing the markets pick back up and you regain whatever you've lost. And often people do so because they're comparing a portfolio of investments, which might hold things like bonds and cash and property infrastructure, various other things. But they're comparing it to, say, the FTSE 100, which is the top 100 companies in the UK, and direct equities. So the two aren't comparable. So they might see in the press that the FTSE 100 is dropping, and they might think that their portfolio will do exactly the same thing. So they will start to disinvest or take that risk off the table.
Yeah, that's even if so you're talking about people who have mixed portfolios, basically. So they've got not just equities, but also bonds, cash, maybe, who knows, property and infrastructure as well.
Yeah, absolutely that. Yeah. So I would say that that's quite a common mistake, because then if you've taken your monies out of the market during a falling market, when do you put it back in? And then all too often you might be putting it in at a higher level. So in effect, you've lost that money. So I would say when it comes to risk, if you see that, if you're in a diversified portfolio of investments and you can see things are falling, just remember it's for the long term. These monies are there for the long term, and it should come back around. When, we can't say, but it will happen.
Yeah, I think that's a really important point, is that, yes, wait for the rebound, but also if you do sell out, you do give yourself another decision to make further down the line, which is when to go back in, of course. So,
absolutely.
Stephanie, thank you so much for your insights today. Thank you for joining us.
No worries. Thank you for having me.
Thank you again to Stefani from Holden and Partners for sharing her thoughts with us. Now, Tom, we've talked a little bit so far about how much risk to take. I think it's probably time to move on to looking at things you can do to invest, to take risk, if you've decided, though, that you are a cautious investor, whether that's because, of the current market environment, you feel a bit cautious, or because just naturally you are cautious and conservative and don't want to open yourself up to losses. So we've pulled together 6 tips for cautious investors. Tom, I think you're up first. Why why panicking is not a good strategy. I always thought that the first rule of panicking is to panic first, but I suspect you're going to tell me that panicking overall is just not acceptable behavior.
Well, acceptable or not, it's not a good move when it comes to investing. So that's because, and I can say this from kind of roughly 2 decades of experience of writing about the markets. Working out what's going to happen next in the financial markets is very tricky, and that's a key reason why it's better to stay invested when you have periods of volatility, which are kind of inevitable in the markets. And there's some research from BlackRock that I quite often look at, particularly when the markets are volatile. So it updates this on an annual basis. It hasn't done it yet for 2020 up to 2025, but the latest exercise that it's done, and it is they quote US figures, but the principles are the same. So they found that if you'd invested $10,000 in the S&P 500 on New Year's Eve in 2004, and you stayed invested right up until the 31st of December 2024, then you'd be sitting on a very healthy pot. Do you want to guess roughly how much you might have?
Give me those dates again.
So you're starting New Year's Eve in 2004.
Yeah.
You stayed invested right up to the 31st of December 2024.
I'm going to say £37,000.
Right. So it's nearly double that. So it's 70,000. Okay. I mean, or just over 70,000.
Okay.
Yeah. Don't worry. Alastair turned the tables on me in the interview I do later, and I came out pretty spectacularly wrong in that one as well. But the point of it is not quite so much that. I mean, it's a good period for US markets, really, because I suppose you're kind of coming out of the dot-com crash that we talked about, and obviously US markets have been particularly strong over the last decade or so. But what do you think the difference would be if you missed the best 5 days for the market over that period?
Okay, I know this is going to be big, so I'm probably going to overcompensate in the opposite direction. But let's say if you missed the best 5 days, probably,
5 days.
Let me say £55,000.
Yeah, so that's much better guess. So it's 45,000, just a little bit over $40,000 in this case. But as I said, the same principles apply. And if you missed the best 25 days, then the total would have shrunk all the way down to a little bit less than $16,000. And the reason why that's very relevant to this idea of not panicking is because very often with the markets, the very best days follow some of the very worst, because it's about kind of the market recovering those losses. So if you sell out in a panic when the markets are doing really poorly, then the danger is that you're kind of missing out on that recovery. And it's why, it's a bit of a hackneyed phrase, I guess, but it's why we always talk about timing the market, timing the market, because it's so hard to actually time the market effectively.
Yeah.
And the best thing to do is not to panic. Doesn't mean you don't have to do you can't do anything, but I think when the market's volatile, don't panic. You want to stay invested for this kind of very reason. I think that the research that I quoted really kind of illustrates that.
Yeah, and I think we've had 2 very good examples recently of this kind of happening in practice.
Yeah.
One was the COVID crash, which was sharp but very short, and there was a huge rebound afterwards. Exactly. The second one was actually very recent. It was after the Liberation Day announcement.
Yeah.
We saw the market absolutely tank and then rebound really strongly. So you can find that those good days in the market really follow very, very quickly after a big shakeout.
100%. Yeah. So let's go on to our second tip, and that's using safe havens. So when we talk about safe havens with investing, we're talking about assets which are relatively uncorrelated. So they don't move in the same direction or to the same extent as the economy and the wider financial markets. And some obvious examples of that include things like gold, bonds, particularly government bonds, and cash. I think I've focused a bit on gold because obviously it's very topical right now. It's as we record, I think it's within sight, or it's around its record highs.
Yeah.
Although it's been very kind of popular in recent times, it's obviously got a real history to it. Most people would be aware that it's been a store of value for thousands of years. And the reason investors like it, or some investors like it during a crisis, is because, unlike currencies, you can't manipulate the value of gold through adjustments to interest rates. Now, that doesn't mean interest rates have no bearing on gold, but they can't directly be be kind of manipulated through interest rates. And also, it's a scarce resource, right? So, and it's expensive to mine. So you can't just increase the supply of gold overnight in the same way that you can increase the supply of money. So that's sort of they're key reasons why gold is popular, and it's also sort of proven very popular at times when there's sort of geopolitical tensions as well.
Yeah.
And it's been supported recent years by buying by central banks. So central banks are looking to sort of diversify their reserves, the kind of cash or the money that they hold, out of dollars and into gold. And that's been particularly evident with countries like China and Russia, who at times have been, at odds with the US over the kind of recent
because
years.
I mean, one of the main sort of benefits of gold if you're a central bank is that you can take delivery of it and bury it in your own territory, right? Whereas your dollar asset, potentially they could be confiscated, and we saw that, not confiscated but frozen with some Russian assets, which are still being debated today in the wake of the Ukraine invasion, which has probably made central banks think about this very issue.
Exactly. I mean, just to give a bit of balance, I guess the criticisms of gold are, it doesn't really have much practical use, unlike other metals, and it doesn't offer any income, unlike other kind of asset classes and other safe havens as well. So bonds, turn to those which do offer income, obviously, and government bonds in particular are seen as being a safe haven. And bonds have traditionally played this role of a kind of a buffer in a portfolio, haven't they? So some people listening will probably be familiar with this classic 60% stocks, 40% bonds, 60-40 portfolio. There have been times more recently where bonds have fallen at the same time as stocks. So this kind of this protection isn't perfect. That in 2022, when you had interest rates rising very rapidly, the dollar was strengthening as central banks tried to get control of inflation coming out of COVID. That was a period where bonds and stocks fell at the same time. But bonds are still, widely used as safe havens. And then, a final one, cash, is probably fairly self-explanatory, although, it's maybe worth noting at this point that the deposit protection limit for the financial services compensation scheme was increased to £120,000 recently. So, there is quite a degree of protection with cash, but we're going to talk about later why, cash isn't necessarily, it doesn't protect you from everything, it's fair to say.
Yeah, I think, it's good that we are going to discuss that later because, it's useful to think about for sure. But I think probably at the moment, the balance in terms of UK wealth holdings is probably a bit too far tilted towards cash. But that probably leads us quite nicely onto our third tip, which is to manage your asset allocation. So in a lot of ways, this moves on from what you were just talking about there, Tom, in terms of safe havens.
Yeah.
Kind of how to use them, isn't it? It's you don't have to invest purely in shares. You can hold these other assets which move in a different way, and probably your classic foil to equities is bonds. And the idea here is that you're holding a portfolio of different assets. They perform well and badly at different times, and as a result you can protect yourself from the full force of stock market downturns. Not all the time, as you said there, but it offers some protection. It does also mean that you don't get the full benefit of market upswings either, but you do get a smoother journey.
And
I think that really begs the question of how much you should hold in shares and how much in bonds and other assets, and that really entirely depends on your financial objectives and your own attitude to risk. But you've already mentioned it, Tom, a strategy that was widely kind of adopted by pension funds in the US in the 1960s, and then went on to be quite popular with retail investors. It's this idea of a 60-40 portfolio comprising 60% in shares and 40% in bonds. And just the broad idea behind this is that you've got the shares there which are going to help deliver long-term growth ahead of inflation, and then you've got those bonds providing some ballast and also generating an income which can be then reinvested for further growth and income. So that 60-40 mix won't necessarily suit everyone, but it is kind of an example of how you can approach the idea of asset allocation. If you wanted to be more adventurous, you could maybe have an 80% in equity and 20% in bonds, or a more cautious investor might go the other way, have 40% in equity and 60% in bonds. So I still think, often these kind of portfolios are mentioned as set and forget portfolios, and I'm often slightly wary about that idea, because it sounds very appealing that you can just choose something, right, and leave it to run. But I do think you need to take into account market conditions. And this comes back to what you were saying, Tom, about 2022, when both stocks and bonds fell. In that year, cautious portfolios actually fell more than more adventurous portfolios, because there was a huge rout in the bond market. And that happened because inflation came back and interest rates rose. And you could really see it, you could see it happening. It was one of those rare occasions in the market where you could see what was going to happen. The result is, what came from a fairly rare set of circumstances, to be sure, where we had record low interest rates and then this huge inflation shock afterwards. And, interest rates from 0 to 5%, really the blink of an eye in market terms. It's always worth kind of sense checking your asset allocation just against market conditions, as well as your own personal preferences. I think just to kind of, to kind of make sure that you're not open to some kind of risk that maybe you hadn't anticipated. And another option, but worth saying, if you do want someone to do all this for you, then there's plenty of what are called multi-asset funds out there. As the name suggests, they invest in a range of different assets, mainly shares and bonds normally, but also sometimes adding gold, maybe property, maybe infrastructure, sometimes absolute return funds in there as well. So they're managed by a professional fund manager. They come in a variety of risk profiles, so you can pick one which matches up with your own risk tolerance. And Tom, I know shortly we're going to be playing an interview that you did with exactly such a fund manager, Alastair Laing from Capital Gearing Trust.
Yes, that will be an interesting interview, and hopefully offer some insights about how multi-asset managers think about their portfolios. But let's get on to our next tip, which is to diversify your exposure across equity sectors and regions. And when you were talking about the market crashes earlier, you made the point that obviously, if you were particularly exposed to certain regions or to certain sectors, you would face a bigger impact from that market crash than you would have done otherwise. So the thinking is that rather than being too focused on any particular area, you diversify yourself across different sectors and geographies, and then you're protected. If something goes wrong in a particular industry or in a certain part of the world, then it's not going to kind of have such a disproportionate impact on your kind of overall portfolio. Now, I mean, the obvious and sort of straightforward way to get that kind of diversified exposure is to look at tracker funds which track global indices, and they'll very quickly allow you to get exposure to upwards of 1,500 companies, so across a number of sectors and across a number of countries. I do think it's worth making the point that because of the current makeup of the MSCI World, which is probably the global index that most trackers will follow, you do have significant exposure to the US market. So that's accounting for somewhere around, a bit more than 70% of the MSCI World, and also to the tech sector as well. And that's because, the Magnificent Seven, Apple, Microsoft, Nvidia, and so on, they all have enormous market valuations. And that means they have a very heavy weighting. They have a disproportionate impact on how much the MSCI World goes up or down. You can get equal weight tracking products. There aren't loads of them, but there are a few. So these are a bit different. So same companies sort of qualify for the index, but they're all given the same weighting. So they all, individually make the same difference to how much the market goes up and down. And that does reduce the kind of weighting towards the US and to the tech sector as well. Obviously, actively managed global trusts and funds, managers can make their own decisions about sector and geography allocation, but that does come with higher fees. And I should say the equal weighted trackers will also have higher fees and obviously a bit more complexity than the traditional ones. And also, if you're looking at an active fund, if it's only investing in, some of them are what we'd say, quite concentrated. They might only invest in 20 or 30 names, so you're getting less of a diversification benefit there. You also have the option, you can look at trackers that track different parts of the world and kind of build your own sort of diversified portfolio as well. So there are lots of options out there, but the general principle is that if you kind of can spread your risk a little bit across different geographies, different sectors, then if something goes wrong in one, you're not necessarily going to be hurt to the same extent as you would be if you're fully focused just in one area.
Yeah, absolutely. I think that's a real conundrum facing investors at the moment, because for many, the obvious way to just get real simple diversified access to the market would be a global tracker fund. And I think that probably comes with a fairly high amount of concentration risk, as you were saying, at the moment. So all those other options definitely worth considering too. And I think that takes us nicely on to our next tip, which is about rebalancing your portfolio, because it can easily get warped out of shape, precisely because of the dynamic you were just discussing, Tom. That some areas of the market performing better than others, and they therefore become a bigger part of your portfolio. So if you start off deciding that you want 60% in equities and 40% in bonds because that's how much risk you want to take, then that's great to begin with. But if you just, as I say, set and forget, look under the bonnet 10 years later, you could easily find that that's now 80% equities and 20% bonds, which unless you've decided you want to get more adventurous, that's no longer appropriate for you. So that can apply at asset class level, it can apply at a regional level, it can apply at a sector level, it can apply at a fund or stock level. Some funds and stocks just have terrific periods, and they can become a really much bigger part of your portfolio than you ever intended if you simply let them run. I would say that strategy has generally been a good one, to just let the winners just run in recent years. And who knows, that may continue. But the risk is, if you've got a very big holding in one sector and there is a reversal in fortunes, it can be particularly painful for you compared to a more diversified approach. So we've got one more tip, I think, Tom. It's a really simple one. It's one of my favorite tips for people who are looking to invest, but maybe just starting out, a bit wary of the volatility of the stock market. It's just a really concrete and simple thing you can do, right?
100%. So this is the idea that you invest little and often. It doesn't have to be that little. Even if you're investing within an ISA and within the limitations of that to shield your investments from HMRC, then assuming you had the capacity and you were lucky enough, you could put up to a little bit more than £1,600 per month away. But I think rather than the kind of how much, it's the regular bit here which is really important. So as you were saying, people can become a bit paralyzed by the idea of when they should invest. Are they investing at the right time? But if you're drip feeding money into the markets on a regular basis, you're kind of taking that concern away, and helping to, I guess, enforce a bit of discipline. You've got this fixed amount that you're putting in, and you can start small and you can obviously build it up over time. But I think just this principle of kind of regularly putting money into the markets. And there's another benefit. There's a phenomenon which is known as pound cost averaging. It's probably the kind of thing that, if I could, I would illustrate with a chart or a table. But in the absence of that, in very basic terms, it's the concept that because you're putting this fixed amount of money regularly into the financial markets, and financial markets, if history is any guide, will inevitably have ups and downs. You're going to buy more with that fixed amount of money when markets go down, and you're going to buy less when markets go up, and that should help to smooth out your returns. Now, I know you've looked at this, Laith, that over time that impact does lessen somewhat because the size of your portfolio, the money that you've already invested, becomes bigger and bigger. But I think it is definitely something that is kind of reassuring when you're worried about, is it the right time? Well, as we said, is timing the market, not timing the market. And if you're regularly drip feeding these funds into the market, then I think that's a really useful tip for people who are feeling nervous right now.
Yeah, 100%. Okay, so I think that's it. That's it for our tips for today. Hopefully, there's a bit in that's a bit of help for everyone listening. We did, as part of that little tour, just mention multi-asset investing. So we're very pleased to bring you an interview with Alastair Laing, who is manager of the Capital Gearing Trust. That's an investment trust, invests across a range of assets, looking for long-term growth, but also with a focus on capital preservation. Tom caught up with Alastair to find out how the trust balances those two different objectives.
Hi, Alastair. Thanks very much for joining us on the podcast. I wanted to ask you a sort of question about the trust and how you manage, clearly it has a mandate of looking to sort of preserve capital, preserve wealth, with the need, obviously, to still generate a return from the investments that you hold.
Yeah, that's right. Our principal objective is the preservation one. I think Warren Buffett memorably said, it's only when the tide goes out that you see who's skinny dipping. And, it's absolutely central that none of our shareholders are left exposed, at the time that things are most vulnerable. I guess to think about it another way, if you think about the purpose of this vehicle, we assume, our shareholders have worked through long careers to build capital, and the most important thing for them is that capital is there when they need it. So we are principally focused on preservation. And then we have a long-term objective for capital growth. Now, we found that needn't mean that returns are pedestrian. But I think core to what we seek to do is to ensure that people's hard-earned savings are kept safe. And so I guess thinking about how do you achieve that, I think our approach is, well, we like to think of it as simple but not easy. I say simple in the sense that we don't use complex derivatives, very esoteric strategies. We have a simple approach. We invest in equities, bonds, and a little bit of gold. But we're just trying to combine those portfolios in a way that delivers the maximum security. And I guess on the basis of show, don't tell, Peter Spiller, who has been running this portfolio, one of the portfolio managers here for 44 years, he started running it in 1982. And over that period of time, the worst NAV total return drawdown at the financial year end has been -4%. So, risk control is incredibly important.
Yeah.
But as I said, that doesn't necessarily mean that returns are pedestrian. The trust has delivered about 8% compound return since 2000, which is about a 6 times total return over that period of time, and actually a little over 200 times since Peter's been running it. So essentially, if you take care of the downside, the power of compound returns looks after the upside.
Okay, that makes a lot of sense. I mean, one thing, and it's not been kind of all the time, but in 2022 in particular, we saw that perhaps bonds didn't offer the protection to a portfolio that they normally would. And you talked about that bonds are a key kind of part of the wealth preservation element of the trust, I guess. So could you talk me through that, and if you're kind of having to be more adaptable in terms of your exposure to bonds in order to sort of for them to retain that kind of protection that you're looking for from them as an asset class?
Yeah, absolutely. So the context there, Tom, exactly as you said, typically our portfolio would have a relatively small amount of equities, typically between about 25 and maybe 40%. We're down towards the lower end of that now, and I'll come to why. We invest in a specialist way in equities through investment trusts, which have been a very effective and profitable way of investing for us historically, and we can touch on that if it's of interest.
Sure.
a majority of the portfolio is then sat in bonds of different sorts. So the first thing to say is that we invest. You're talking about the protection offered by bonds.
Yeah.
And the first question is protection from what? The principal risk for bond investors, at least high quality bond investors, is the risk of inflation and unexpected inflation. So the first thing I would say is that we have a large chunk of the portfolio invested in what are called index-linked bonds or inflation-protected bonds. However, the key point is, as an asset class, it delivers you a return over and above inflation. So we are not guessing with a majority of the bonds that we hold, if we hold them through to maturity, whether they're going to deliver returns above inflation. We know that that will be the case. So they deliver an inflation plus return. However, you made a very good point. In 2022, a lot of these instruments performed very poorly. And that is because there was, after the Liz Truss Kwarteng debacle, there was just a huge sell-off in the bond market.
Yeah.
And a lot of people were disappointed. But interestingly, the best performing part of our portfolio in that period was actually UK index-linked bonds. It was an incredibly weak market. I think the long duration bonds were off 70%, something like that.
Yeah.
We had short duration bonds. That is to say, we benefited from the inflation protection, but we didn't get hit too much by the rise in interest rates. Suffice to say, bonds are not some homogenous category. No. Exactly as you were pointing out, you can invest shorter duration, longer duration, investment protected or not, government bonds, corporate credit. And really a lot of what we do for our shareholders is thinking how to mix those different kind of bond assets to deliver the defensive downside. And then, as I say, we have that small portion of equities that we're trying to work very hard to deliver the upside.
Yeah, no, that's really interesting. You mentioned obviously that you're kind of on the low side in terms of equities at the moment, and perhaps it would be worth exploring that a little bit, why you're kind of positioned that way heading into 2026 and what that kind of reflects about your feelings on the outlook.
Yeah. Okay. The first thing we would say is that our capacity to forecast what's going to happen to the stock market over the next 12 months is kind of pretty much zero.
Like anybody.
Any 10-year period, equities tend to go up in a little bit in 8 of those years and drop a lot in 2 of those years, something like that. It depends on the business cycle, equity cycle, those kind of things. So really how we think about our role is, as equity market cycles kind of grow and mature, we will be trying to act in a kind of counter-cyclical fashion. So we will be reducing our equity exposure. Now, we're conscious that we can be wrong. We'll never go below a certain level, but we are very concerned about equities and particularly US equities. And I guess to kind of try and illustrate that, there was a lot of conversation last year about, and really continues this year, about whether the current AI boom is like the dot-com boom. And in there are elements that it is, and there are elements that it isn't. But there was an amazing quote from 2003. I remember reading it at the time, from Scott McNealy, who was the CEO of Sun Microsystems, which was really the open AI of its day. It made these special servers. It was the Java coding language, and it peaked in its valuation in 2000 in excess of 200 billion. But by 2003, it had fallen 95%. And there was shareholders were understandably furious about it, and there was lots of questions about the accounting. And I remember this very clearly, turning around and he just said, look, it's nothing to do with the accounting. You invested at 10 times revenues. what were you thinking? And almost this mindset of the issue wasn't the company itself, it wasn't the technology, it was investors' expectations. So the reason why I say this 10 times revenue, what were you thinking, was because we recently, a couple of months ago, we had an intern in, and I could see his eyes were very wide thinking about the AI opportunity that's around us. And so I just asked him, look, can you do a piece of work for me to look at the portion of the S&P 500 which is trading today at greater than 10 times revenue by value? And I didn't really know. I had a general sense of where this will come out, but Tom, maybe I'll put it to you. So to give you some framing reference, normally about 5% of the S&P 500 trades at greater than 10 times revenue, this what were you thinking level. In the peak of the dot-com boom, I think it was about 12 or 13% of the S&P 500 above 10 times revenue. And
I'll split the difference. I like how you turn the tables. 9%.
9%. Well, the answer came out, and it was a surprise to me, 33%.
Wow. Okay. I went way too low.
33%. As far as we're aware, this has never happened before. To have, this, I think we should patent it, this what were you thinking index. But, it is just one way of looking at a market that could be peak multiples on peak earnings, which would be the brew for a very serious recession. And the reality is, I don't know. And sorry, even that 33% of revenues, by the way, doesn't include Alphabet, which is at 9.6 times revenues today. It doesn't include Amazon, because Amazon has this large consumer business that's actually quite low margin, but undoubtedly the kind of AWS part of the business would be. So, this is just one window, and it's extreme one, and I'm telling a story to paint a picture.
Sure.
But I guess we don't know what will happen with AI. 2026 could be another, 8% up year, and we've missed that opportunity. But we just say to investors, have a bit in there, but make sure you have something defensive, because if this turns out to be an unsustainable situation, we have never seen something like this before, and the downsides could be really quite significant.
Yeah, that's really interesting. Just to round things off a little bit, you mentioned that you have some gold exposure. It's relatively limited, isn't it, within the trust? But I just wondered what you think about gold. Obviously had an exceptional year in 2025. How you see that as a kind of a tool for kind of offering protection.
Well, the main thing I think about gold is I wish we'd had more of it in the portfolio. As you politely pointed out, we didn't have quite enough. So gold is just such a fascinating topic, and to be honest, we could talk about it for hours.
Of course, yeah.
And we always get a lot of this, but we start from this fascinating question of kind of what is gold. It has this historic link with money, but it's not money anymore. Bretton Woods severed the last link with money. The end of the Bretton Woods system in 1971, when Nixon closed the gold window. We can't go to your corner shop and buy something there. It's not a unit of an account. It is somewhat a store of wealth. But when we come on to that store of wealth thing, it is incredibly volatile. As you pointed out, it went up an awful lot last year, and it could go down quite a lot. So it's a very volatile store of wealth. Frankly, it looks a bit like a commodity. It trades a bit like a commodity, and indeed it is a commodity. The great thing about gold is it's a commodity that doesn't deteriorate. It's hard to store oil or whatever. But that volatility makes it, the other thing that sometimes people claim is that it's a hedge against inflation, but it seems quite obviously to us not to be. From the gold peak in 1982 to what we call the Gordon Brown lows, when he sold off the whole of the Bank of England's gold reserve, it had fallen by about 80% in real terms. And since then, it's gone up 6 times in real terms. So I guess as we look at it, the things that drive that volatility are actually incredibly complex to analyze. And because it has no yield, it's very hard to do a fundamental valuation on it.
Yeah.
So we look at things like index-linked bonds almost as a modern version of gold. When Bretton Woods closed, we went from a gold-based system essentially to a dollar-based financial system. US index-linked bonds, in our view, are the global lowest risk asset denominated in the global reserve currency. So we hold the US index-linked bond in a ratio of about 20-1 to gold, because we can analyze those. We may get it wrong, but we can explain why we invested in it. So we sit here with a great sense of regret we didn't have more last year. But essentially, for shareholders that really do believe in gold, they can access it themselves very easily and very cheaply. Why pay us to hold it? We have a specialism in analysing bonds, so that we stick to our knitting there.
Thanks again to Alastair Laing from Capital Gearing Trust for coming to talk to us. Now, we've spoken quite a lot about how to mitigate risks to your investment portfolios, but those aren't the only risks you need to watch out for, are they, Laith?
Yeah, people tend to think, of course, of investing in the stock market as a risky endeavor, which it is because it's volatile and there's the risk of loss. But that isn't, I'm afraid, the only risk in town. There are other risks, and I'd highlight two more in particular, which kind of stem from taking a more cautious approach, strangely. Especially one which relies solely or predominantly on cash, which we know lots of people in the UK do. So the first risk I would highlight is not hitting your financial targets. And a really simple one to think about in this context is getting to retirement without enough money. Now that leaves you in a fairly precarious position. You have to retire later and build up more savings, which you might not want to do, or B, simply just have to accept that you're making do with a less comfortable retirement. Also not a particularly palatable decision to have to make. There are two ways of avoiding that problem. One is to save more during your lifetime, or the other is to invest in riskier assets with that long-term money. So just to illustrate this with example, if you've put £200 a month into investments over the last 20 years, if you'd just gone into a global equity fund, so 100% into the global stock market, that would be worth around £130,000 today. If you'd put that into a cautious managed fund, so a much more cautious fund, only invested somewhere around 50% in the stock market and around 50% in bonds and other assets, rather than £130,000, you'd have £77,000. So both of those are good results compared to not saving at all, of course.
Yeah.
But obviously there's a big difference. Now, it's important to say, I think, you can still hit the same financial target. Let's say that's that £130,000 by investing cautiously, but you have to put in more money along the way. So rather than £200 a month to hit that £130,000 from a cautious managed fund, you would have had to save £350 a month. So, we started off talking about this, didn't we, Tom? Is that, the less risk you take, the lower your long-term rewards would be. And that's an illustration of that. It's absolutely fine for you to take that approach, but just be aware, if you want to hit the same financial targets, then you may have to save more money along the way. So that's kind of one risk, is not hitting your financial objectives. The second risk, has been pretty topical in recent years, is inflation risk. So if you hold your money in low returning assets, especially like cash, then you risk it losing its buying power year after year. And that's especially damaging when you've got high periods of very high inflation, like we saw in 2022 coming into 2023. And I think that's perhaps particularly damaging in the UK because, we're so familiar with cash, aren't we? We hold probably too much of it. Even the financial watchdog thinks so and is trying to do something about it. So, Tom, I just think as a nation, we do tend to hoard cash, don't we?
Yeah, I think it's not an unfair characterization. I mean, you mentioned the financial regulator there. The Financial Conduct Authority actually put some figures out last year, and I think 61% of people who had more than £10,000 in investable assets held at least 3/4 of that in cash. Now, I mean, we talked about cash and how, it's got this measure of protection and it can play an important role. And obviously, I think there's very sound advice out there about having a rainy day fund in case, you lose your job unexpectedly or some really big expense that comes along unexpectedly. But the returns from cash, as you say, typically, barely or haven't really matched up to inflation. So, yes, build up that rainy day fund, but I think there's a strong case for at least considering what you do with money that you have on top of that, if you want to achieve the kind of goals that you were talking about there.
Yeah, and just finally, I think it's worth just talking about the current market environment. I know people are probably quite nervous about valuations in the US stock market.
Yeah.
Legitimately so. And we spoke at the beginning of the pod about, what could happen in the worst case scenario. How bad can market crashes be? And it's really, really easy to focus just on that and totally lose sight of the returns that you get during booming markets. And I think we can illustrate that a little bit just by looking back at the .com boom in the late 1990s. So we talked earlier about, if you'd invested at worst possible time, you would have lost 50% of your money coming out at the worst possible time. But if you look at the boom before the bust, just run through each individual year of returns from the US stock market for you, Tom. In 1995, the US stock market returned 39%. In 1996, it returned 11.6%. At the end of 1996, Alan Greenspan, who was then the chairman of the Federal Reserve, warned about irrational exuberance in markets. Really unusual step for a Federal Reserve chairman to take because he was worried about overvaluation. But we go on. In 1997, the market returned another 39%. In 1998, it returned another 27%. In 1999, it returned another 25%. In 2000, well, we already know what happened there. And I think the point that I'm trying to make is that, yes, there's a growing consensus that the US stock market is in a bubble. But even if that is correct, it does matter where in that bubble you are. And, we're at the beginning of a new year. Could there be a market correction in 2026? Absolutely, there could. But equally, that lesson from history tells us that, there could yet be, years potentially of strong returns ahead. So if you stand out of the market now, that's, understandable. But you have to be willing to then accept that you may be sitting on the sidelines of a rising market for a considerable time to come, and that is going to be difficult as well. And hopefully in this podcast we've provided some ways that you can maybe have your cake and eat it a little bit as well by taking on some risk but also mitigating it too.
Okay, I think that's all we have time for on this episode. We hope you've enjoyed it, found it useful. The weekly Money and Markets podcast will be back later on this week. In the meantime, thanks for listening, and we'll catch you on the next one.
This podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. The value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.